You've probably seen it pop up on your feed, right? This simple, almost magical-sounding formula that promises to make you a crorepati. It's called the 15x15x15 rule, and it has gone absolutely viral. But is it the golden ticket to wealth, or just a nice idea that's a bit too good to be true? Let's find out. I mean, seriously? A simple formula to make 1 crore rupees? It sounds amazing. But you gotta ask, does the math actually hold up? Let's dive in and break down exactly how this viral strategy is supposed to work. All right, first things first. What is the 15x15x15 rule? Let's unpack the exact formula that has got everybody talking. Okay, here it is in a nutshell. It's built on 3 pillars, all around the number 15. You invest 15,000 rupees every single month. You do that for 15 years straight, and you aim for an average annual return of 15%. On the surface, it sounds incredibly simple, doesn't it? So let's look at those 3 pillars again. First, the value. That's your disciplined systematic investment plan, your SIP, of 15,000 rupees. Second, the tenure. You need the patience to stick with it for a full 15 years. And third, the yield. This is where you target that pretty ambitious 15% average annual return.
But how do those numbers create such a massive result? Well, the secret sauce, the real engine behind this whole formula, is a force that's often called the 8th wonder of the world: compounding.
You know, this famous quote really says it all. Compounding is simply when your returns start generating their own returns. It's like a snowball effect. Your money works for you, and then the money it earns also starts working for you. That, my friends, is where the real magic happens.
And this table right here, this shows you exactly how that growth just explodes over time. Just look at the jump between your 10 and your 15. Your invested amount goes up by 9 lakh, sure, but your total corpus more than doubles. The estimated return skyrockets from under 24 lakh to almost 75 lakh in just those last 5 years. That is the power of compounding in action. It's insane.
And there you have it. After 15 years of following the rule perfectly, the math totally checks out. You cross the 1 crore mark. On paper, this formula is a thing of beauty.
Now this chart, this really shows the most powerful part of the whole equation. Look at this breakdown. Out of your final crore, only about 27% is the money you actually put in from your pocket. A whopping 73% of your wealth comes from your returns earning more returns. Your money did most of the heavy lifting for you. Okay, the math is definitely compelling. But you know, a formula is only as good as its assumptions. So I think it's time for a little reality check. Let's put this rule under the microscope and see if it really holds up in the real world.
I mean, this is the 1 crore rupee question, isn't it? And the short, honest answer is nope, no way. While some funds have given these kinds of returns in the past, it is never, ever a guarantee. The market just doesn't work on promises.
This analogy is just perfect. Banking on a 15% return year after year is like expecting every single cricket match to end with a 6 on the last ball. It's an incredible, thrilling outcome when it happens, but you can't reliably plan your entire future around it. So this is where we need to separate what you can control from what you can't. You are in the driver's seat for 2 out of the 3 variables: how much you invest and for how long you stay invested. But that third one, the market return, that's completely out of your hands.
And then there's this other thing we need to talk about, the silent wealth killer, inflation. That 1 crore rupees you're aiming for, well, it won't feel like a crore in 15 years. Assuming an average inflation of just 5%, its real purchasing power could be closer to about 48 lakhs in today's money. So you'd be a crorepati on paper, but not really in practice.
But look, beyond all the math and the markets, there's one final obstacle that no calculator can ever account for, and that's us. It's human nature. Our own behavior can be the biggest threat to any long-term plan we make. Just think about it for a second. We get scared during market downturns, and we're tempted to panic sell. We see some hot new fund everyone's talking about, and we want to chase it. Or, you know, life happens. A personal crisis forces us to stop our SIPs. These are the real-life derailers that can stop that compounding magic right in its tracks.
And here's the proof. The data is pretty clear. Most mutual fund investors in India stay invested for less than 2 years, not the 15 years this rule requires. This just shows the massive gap between what we want to do and what we actually do. The biggest risk isn't a bad market, it's leaving the market way too soon.
So, if the 15x15x15 rule is more of a guideline than a guarantee, what's the real path to wealth?
Well, it's about focusing on the timeless principles behind the formula, not getting hung up on the rigid numbers themselves.
This table right here says it all. Check out these two investors. They both invest the same $5,000 a month. They both get the same 12% return. The only difference, investor A started just 10 years earlier. Now, by investing only 6 lakh rupees more in total, their final corpus is nearly 3 times larger. This is absolute proof that when you start is so much more important than how much you start with.
So here are the real secrets, if you can even call them that. Forget magic formulas and just focus on these principles. Start as early as you possibly can. Be relentlessly consistent with your SIPs. Diversify your portfolio. And aim for realistic returns. Historically, 10 to 12% is a much more grounded target for long-term equity. Then, just give compounding the time it needs, decades, to work its quiet magic.
Look, at the end of the day, the 15 by 15 by 15 rule is brilliant marketing. It gives investors a simple, motivating goal, and that's great. But real wealth isn't built on a catchy formula. It's built on a mindset of discipline, of patience, and of realistic expectations. So I guess the real question for you is, are you just chasing a number, or are you ready to build the right mindset?